And you can make a ton of money following the trend if you stop following the trend at the right time. So for people who sold out in 21, 22, early part of 22, great. They banked the wins. For people who hung on because they wanted to get one more turn, or they wanted to return half the fund or the whole fund or whatever, and things got re-rated and retention went down and growth is now down and now profits have to come up. I mean, that's a tough transition to make. And you're seeing a lot of management teams get swapped out.
Welcome to the Private Equity Value Creation Podcast, where we interview leading investors, operators, bankers, and advisors to help you answer one question: how do we increase the enterprise value of our companies? My name is Shiv and Devin. I'm your host and also the CEO of a management consulting firm called How to SaaS. And each episode, I will dive deep with a guest to help you become a better value creator and capital allocator. My guest today is Devin Mathews, and he is the partner at ParkerGale Capital. And what's interesting about ParkerGale is that they invest in smaller B2B SaaS companies, somewhere in the 10 to 25 million range. And they're competing in a space where not a lot of PE firms deploy their capital, because most PE firms have larger funds and are investing in much bigger companies. But what was really interesting about Devin is that given that they're focused on these smaller companies, there's a different approach that they take to growing these businesses and to create alpha for their fund and for their LPs. And one of the things that I really liked about what Devin mentioned on the episode is this idea of being unconventionally right as a way to drive value, because when you're conventionally right, you drive far less alpha versus when you're unconventionally right. So I really appreciated that perspective. And the other side of it that I really liked is he had a very meticulous and deliberate approach about growing companies, which I think more PE firms and founders need to look at as an approach to grow their respective businesses. So there's a lot of great takeaways for you as a listener when you're thinking about your company and what to do best with it going forward. So I hope you take away from it just as much as I did. Enjoy the episode. All right, Devin, welcome to the show. How's it going?
It's going great. Thanks for asking, Shiv.
Super excited to have you on. So why don't we start by sharing a background about yourself and ParkerGale, and we'll take it from there.
Yeah, you want the long version or the really short version?
The long version sounds great.
No, grew up in upstate New York, one of four boys, so packed in the middle, and kind of a intellectually competitive crew of people I grew up with, brothers and parents and things. So never intended to get into finance. I was an art history major in college. Moved out to Chicago to get a PhD in sociology at the University of Chicago. Chickened out and applied for a job. This is the early 90s when you actually answered ads in the paper for a research job at a place called William Blair. I didn't know what William Blair was. Apparently it was an investment bank. I didn't know what investment banking was, but the guy who interviewed me liked me, assumed I was a good writer given what I had done in college, and he was transitioning his research list and needed somebody to help kind of write the report. Back then, William Blair used to write the definitive research report on a stock, and they were totally focused on emerging growth. So luckily I got assigned to the video game industry. So it could have been a lot worse. I could have been following the packaged air and kitty litter industry, which were two companies that Blair followed at the time. So I got to play video games, write research report about it, and learn finance from a few really brilliant and super kind people. And did that for 2 years. Then my boss said, "Hey, you should go work in the private equity department." William Blair had just raised its fourth private equity fund, and I was the analyst in that fund for a few years. Went to business school, and then I spent 5 years in Boston at Great Hill Partners with Bryce Youngren, one of your prior guests and a good friend. And then I rejoined my old team at William Blair, who had spun out to start Chicago Growth. I was one of the four partners there and ran the tech practice. And then about 10 years ago, me and my operating guy decided to spin out and start ParkerGale. So each time I've moved to kind of something smaller and more specific. So eventually it'll just be like me and one portfolio company.
Yeah, or you starting a company from scratch. Yeah, that's a
Yeah,
great story. So why don't you dive deeper into that experience? And usually we don't do this on episodes, but given that you've worked at so many reputable firms and been a part of that journey, like William Blair is one of the biggest investment banking firms that advises all kinds of software transactions. So would love to learn about the lessons from there and then how that translated into Great Hill and what you're doing now.
sure. Yeah, I had no idea what William Blair was, and I still have the Facebook that they put out in 1995 because my office manager here at ParkerGale and I started working together in 1995. So we have the Facebook from that, which was literally a printed book of everybody by department. I think there might be have been 300 people in there, maybe 200, 250. I think Blair probably has 1,500 people just in investment banking right now. So that's interest. I was there at an interesting time. It was still felt family owned and family run. Bowen Blair and the Blairs, the sons of the founder, were still walking around the office. So it was just a really special place to be. So the first part of my career, I learned how to value a public company and analyze it, and then I moved into private equity, and I was taught how to value a private company. I think it's a very similar process, except for public companies, there's a limited universe. There's X number of public video game, software companies. So Activision, Broderbund, Electronic Arts, all those names, some of which are still around, some of which aren't. In the private markets, it's kind of everything, right? Public markets, pre-Reg FD, you got to know everything about the business, quite a bit. Now, not so much. You can't know things that other people don't know because of Reg FD, which is a good thing in general, but has certainly made covering public companies harder, or at least having deep, keen insight into it. And then on the private side, it's like, okay, I like this segment. I like this industry. Okay, what do I like about that industry? What are the companies in the industry? Okay, what is the best part of the company? So an investment I worked on at Great Hill Partners called Vigo Remittance Corp was a Western Union competitor, but only the part of Western Union that was U.S. to Mexico. Largely, they did other things, but the biggest revenue source was recent immigrants from Mexico sending money home to their families. So I had covered First Data. So I knew the First Data business well. I thought the best part of the First Data business was Western Union. I thought the best part of the Western Union business was remittances. And the remittances, they were charging 30% to send $200. Might cost you $40 to $60 to send 200 because they had no competition and they had great service and it was secure and all that. But there were these other solutions out there that were just as good, just as secure. They just weren't as well known and branded. So that was a thesis we built at Great Hill. We executed it well. Sold the business to Western Union because we were doing more transactions to Mexico than they were, even though we were such a small business compared to them. But again, that's the process, I think, of finding a good investment. Go macro to micro, micro to macro. And the difference is in private companies, if you knew as much about a public stock before you bought it, or the company before you bought their stock, as you do about a private company before you buy the company, you would never buy a stock. You would never buy it.
Why do you say that?
Because we get to see all the warts in these businesses before we buy them, and we still buy them. Whether it's financially a perfect business from the outside, or or a turnaround. Every business at this scale, in the private equity scale, and just like Bryce, I live at the lower end of the middle market, like the micro end of that market. If you know Brett Bashore from Permanent Equity, who is a brilliant guy and everybody should follow, and really more around Main Street businesses than the software side. I think his quote is every private company is every company is a loose collection of complete chaos. And the fact that they actually can, move forward and thrive is always a shock when you get under the covers. So then at Great Hill, I learned how to source. It was a typical East Coast, Boston, sourcing machine. The junior employees were sourcing aggressively. And I didn't have to do that much at William Blair because I had such a good reputation. The phone just rang and we worked on what we worked on. So that was another tool in the toolkit. And then when I was reunited with Jim Milbury, my operating guy at William Blair Capital, and then my operating guy at Chicago Growth Partners, it was, kind of a reunited and it feels so good situation. And after 5 years of doing a nice job at CGP, we decided to take the show on the road and raise our own fund.
That's an amazing story. I want to touch on a bunch of things that you brought up. So let's start with this private versus public. And if you knew what you knew about private companies, you wouldn't buy stock. Dive a little bit deeper into that. Like what we've seen when we work with our clients and private equity firms, and you look under the hood, there is chaos. There is a lot of data is not in order. It's hard to understand how well things are working, and not everybody inside has a complete picture of where money's being invested or what the ROI is, and all kinds of things. But just curious from your perspective, what have you seen inside these companies that lead you to that perspective?
Well, I've been doing this coming on 30 years. And you just see the same thing over and over again. You see really passionate founders. Now, we only buy from family-owned businesses and founder-owned businesses, only software businesses. So my whole career has been software, first institutional capital, buying from families and founders. We could talk about why that is and why that's our sweet spot. When you're buying a 40-year-old software business that's had one owner, no outside capital, no board, they're probably not doing things the private equity way, which in a lot of cases is good, right? They have deep connection to their customers. They have deep discipline on margin and profits because they're not funding it with somebody else's money. But a lot of the things that we would view in kind of the value creation plan, just basic execution, have either been put to the side or delayed. Founders are either building businesses out of pure passion. Some of those do well, some of those don't do well. They're doing it for profit, right? So let me maximize profits at the expense of growth. And if you owned a business in your 70s or 80s, why wouldn't you do that? If the cash was more every month in the bank account, why would you be so worried about growth? They have no idea what the rule of 40 is or LTV to CAC, and they don't care because they own the business and they're doing fine. Or they're running it for ego or other things like, hey, I'm not going to be that profitable because I want an office in Zurich and Melbourne and other places because I like going to visit those places. So maybe, you not running it as efficiently as they could. So our investment thesis is we're looking for gaps between, opportunity and value. So we want to find businesses that aren't being run to maximize enterprise value.
Do you find that, and I like how you phrase that, which is they're not as familiar with the PE playbook, but that's often a good thing. And some of the things that you listed, like deep connection to customers, as a founder, like I deeply identify with that because there's a connection to customers and our clients that I have that somebody coming from the outside may not necessarily have. And that's an advantage because you're so close to the customer, you understand how their needs have evolved over time. Like for example, what private equity needed 2 years ago versus what they need now is very different in the current market environment. And we understand that because we're so close to customers. So stuff like that, how do you preserve that when institutional capital comes in and now value creation is more important? Driving rule of 40 might become a priority, and maybe the previous founder is transitioning out and there's a professional management team coming into place. Like, how do you preserve that essence that made that business great in the first place?
Yeah, I'd say we're often capturing a business when the owners are starting to play not to lose rather than play to win. So they all started these businesses 10, 20, 40 years ago, and we've bought companies, that old. So they're making choices around what's important to them. And so why would you hire a new CFO or hire 5 more salespeople to grow faster if you thought you might sell the business in a year or two, right? Those just aren't you're not maximizing your utility. So we're trying to capture a business that is, doesn't have the foot on the accelerator. Now, I'd love to buy a business that's growing, the pure rule of 40 business, never raised capital, wildly profitable, great growth profile, doing all the right things. But that person's going to hire a banker, run a process, and get a very rich price, even in this market today. I mean, we're still seeing pricing. So we're still seeing 2021 pricing for A assets in this market. So that's not a segment of the market we compete in. Our view is, right, there's buying companies and there's making them better and they're selling them, and then there's running a fund. So we're trying to generate a return that's in excess of what our investors could get doing other things. And everybody knows the 2x2. You could either be conventional and right or conventional and wrong, and unconventional right, unconventional wrong. And the only way to outperform your peers is to be unconventional and right. Right? Some people may say contrarian, but I like unconventional more than contrarian, because buying software companies today isn't very contrarian. Maybe the way we do it may be unconventional. People can decide. But if I just buy great software companies in processes, I'm basically buying the index, because everybody's doing that. So I'm either going to be a little bit better or a little bit worse than everybody else. If I'm doing stuff that other people aren't doing and I'm good at it, then I can outperform the market in some given time. So
what is that for you? What is that unconventional approach?
Yeah, unconventional is like we buy companies that other funds think is in the too hard pile. So in the current market, there aren't a lot of small funds. So that's one. So if you go back to what Bryce's conversation was, there's 70% of the money chasing 4% of the companies or something crazy like that, right? There will be more small companies than there are big companies. In the last 5 years, there's more money in big funds than small funds. There's never been a bigger move to scale and quality, perceived quality and certainly in the last 2 years. There's 2x the amount of money in $5 billion plus tech funds than there was, 5 years ago. And there's half as much money in sub $500 million tech focused buyout funds than there was 5 years ago. So that's unconventional. Most people have exited the small end of the market and they're moving up market. That's one. We focus on the small end of the market, 10 to 30 million of revenue companies, founder owned, family owned, never raised outside capital. So they have to be profitable. I don't need a lot of growth, right? We'll improve the growth if we do our job right. It doesn't need to be wildly profitable. I'm probably going to spend some of the business's profits in the first couple of years to bring in a more professional team, pay down tech debt through our hands-on operating model, build out a sales team. So there's often underinvestment in sales, no marketing to speak of, tech debt, and growth that isn't repeatable, right? It's either episodic or it's just nascent. But if you buy a system of record in a decent end market, where we look for high market share, like high NPS, high market share, low market awareness. So I'm the number 5 player in we owned a accounting business, software business for law firms. They're the number 4 market share and the number 14 market awareness. Why is that? It was owned by 2 guys in their 70s who didn't market. They just had a couple salespeople who sold directly to customers. They weren't on LinkedIn. They weren't doing content marketing. They weren't doing lead gen. They weren't, optimizing the funnel, no SEO, SEM. It was just, they owned the business. They did what they want with it. They did very well on the exit to us outside of a process, kept some of the equity for themselves, and we brought in a new executive team at their request. I mean, we are often the exit for the founder, almost always. I would say almost always, in all but one instance, we are the exit for the founder. And that is why they're coming to us. Like, hey, I'm selling my business. I'm stepping away. We hear you're the team that does that. A lot of other funds would view that as a big negative sign. The founder's walking away. Why would the founder walk away? Well, if I was a 35-year-old founder who was going to put $30 million in my pocket and you needed to make 300, sell for 300, to make your return. Well, okay, maybe you want me to stick around. Maybe you want me to have a ton of skin in the game. Maybe you don't want to go through that complexity. Well, we don't do stuff like that, right? I don't need the founder to stick around to execute the business, because I'm going to execute it in a different way at a different pace than he or she did. So we're looking for businesses with those types of dynamics. And that's often a business that no banker in their right mind, especially William Blair and company, ever take on for a sale, because it's going to be hard.
It's going to be hard to sell, because not enough buyers are out there. So actually, just funny side story, and I have a question as a follow-up to what you just said. But one of the ways I discovered the thesis for this market is Bryce was having an event for all of his portfolio companies. So he asked me to come and speak, and somebody from William Blair gave a presentation about how multiples in this market were increasing and how much money was being deployed during diligence and post-close. And that's when I learned about the volume of capital moving through this space, and that's when I decided to go kind of all in on this business. But coming to that point is that a firm like William Blair or the bigger PE firms out there wouldn't necessarily buy a lot of these companies, and with good reason. Maybe they don't have great retention, or profit margins aren't at the rate that they want it to be, or revenue's not where they want it to be to write the right kind of check size, or they're not growing fast enough. So looking at those kinds of companies in your shoes, you could be walking into a situation where there are some fundamental things that need to be fixed. Like, for example, net revenue retention. If it's not in a great place, you can kind of get stuck with an asset that doesn't have great expansion opportunities or able to retain its customers, especially in these kind of old models that are run by families or founder only type of businesses. And maybe they haven't invested enough into improving the product over time, and it's in a super competitive space. So how do you navigate that? Because you can easily deploy capital in a situation where now you have to throw good money after bad to recover that investment.
Yeah, well, I mean, I guess that presumes that we didn't do a lot of diligence. So the throwing good money after bad, I would say at what price? So 2 years ago, 3 years ago, even today, a lot of funds are very comfortable paying double-digit revenue multiples, right? Double-digit forward ARR multiples still today. So that's great if the growth continues and if the market still rewards businesses with those profiles at those values. So in the massacre of June 2022, everything got re-rated. Pretty much everything got re-rated in the public markets for sure, right? So if you bought a business growing 40%, break even, and you paid 12 times forward revenue for it, you probably got back then 2-3 turns of revenue debt on it, would be my guess. So 80% of the cap structure is now equity. We all know growth has slowed down, and we all know in June 22 things got re-rated. So that 12 times revenue business might be worth 6 or 7, or maybe it's worth 8 or 9. And if you're growing 40%, it's hard to grow 40% 4 or 5 years in a row. So maybe you're growing 20, 25% now. So just run the simple math. And I posted it on LinkedIn. I did a series called Good Company, Bad Valuation. You can take the Google sheet that I built. If you look at my profile and my posts on LinkedIn, you can run the math yourself. Okay, I paid this much for it. The growth rate looks like this. The multiples have compressed. It's impossible to outrun multiple compression of this magnitude. So that's one way to make money, is the market's going to stay. It's a trend following game. And you can make a ton of money following the trend if you stop following the trend at the right time. So for people who sold out in 21, 22, early part of 22, great. They banked the wins. For people who hung on because they wanted to get one more turn, or they wanted to return half the fund or the whole fund or whatever, and things got re-rated and retention went down and growth is now down and now profits have to come up. I mean, that's a tough transition to make. And you're seeing a lot of management teams get swapped out. Right, you had a grower, now you need a grinder. So you're seeing that all over the place if you talk to the headhunters. Our view is enter at a compelling valuation. Try not to fall into the value trap, right? Which is I bought it because it's cheap. And we've fallen into that before. And we spend a lot of time in diligence making sure, do we like this for more than just the valuation? But you're talking to a guy who 2.5 years ago bought a fax software business in Boston from a 91-year-old who started the business in 1985 after taking early retirement from Wang Laboratories. So most of your listeners don't know what Wang Laboratories is, but it was one of the first PC companies that got beat by IBM. So he left that in 1985 and started a fax board business that turned into a fax software business. So why would we do that? Because they cared a ton about product. They were all engineers. They had 60 employees. It was wildly profitable. They were not selling in any kind of professional way. They had amazing retention, but very little organic growth. And it was a really sticky product in a highly regulated industry. So we replaced 40 of the 60 employees in the first 12 months of our ownership, including the entire executive team. But that was the deal. That was no surprise to the sellers, and it was no surprise to the employees. But if you signed up to work for a 91-year-old in Boston to work at a fax business, you did not sign up to work for a private equity firm that needs to make multiples of a capital in a short period of time. So we're very upfront and open about that with the sellers and the employees of the team, which is, hey, we're going to ask you to do things you haven't done before. A lot of it may not make sense to you. We will teach you all of it. If you want to run with us, this will be hard and fun. And if you don't, we will give you a very generous path to somewhere else, and we'll help place you at a place that's more your speed. And then you have to attract a team to go do that. So that's kind of how do we get that magic of like keeping the past good, but also, accelerating the business. There's two tools in private equity, I think: urgency and empathy, right? Not a lot of, I know maybe people talk more about cash flow and growth, but I'll talk about urgency and empathy. All urgency, no empathy. Like that's the worst boss you ever had. That's the meanest coach you ever had, right? It's all urgency now, 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 now. Zero empathy for how hard that is to do, especially in a 40-year-old business where you're trying to, rebuild the boat while it's sailing. And we can get into the philosophy of Theseus's ship and all that stuff, but we'll skip that for another conversation. Is it the same boat if you've changed every board on it as you're sailing across, the Mediterranean? Probably not. And then all empathy, no urgency. I mean, that's Nana. I mean, Nana's awesome. Nana just loves you and wants to give you a hug and tell you how amazing you are and send you a check for $5 on your birthday. I had two great Nanas. But that's all empathy, no urgency. So that's not pushing you to be great. That's just loving you for what you are and who you are. And that's awesome. But trying to balance empathy and urgency as an investor with a management team trying to do hard things, right? All of our deals are hard. All of them are hard. The people who sign up to work in them are hard. We're taking a business that's been around for a long time, and we're trying to completely change the trajectory of it in a very short period of time. And it can be emotionally rewarding, financially rewarding. And you can look back and say, I did that. Versus, hey, I bought a perfect company and I paid the most for it in an auction. And it continued to be perfect. I owned it. I probably can't say that I had a whole lot of impact on it because it was a great team, great market, great execution. And then somebody paid me a lot more for it. That's awesome. I'm all for that. And there's, a lot of people in my segment of the market who do that, but you're either going to be a little better than them or a little worse than them. I'm trying to be significantly better than my peer set. And yeah, eventually we'll get it right. And we'll do that. But, that's how we think about investing.
Yeah, that's coming to the unconventional right versus conventional right concept that we're talking about earlier. I guess my question, even in the facts example that you gave, like, how do you factor in for the risk that I'm assuming your goal here with an investment like that is to eventually flip it as a way to return it, or are you counting on profits and cash distributions to make that up? And then how do you factor in for the fact that if you are going to sell this business, when you try to sell it, the market of potential buyers, similarly, because it's an unconventional thought to buy it when you bought it, there won't be enough buyers at that point in time. And how do you kind of hedge for that?
Yeah, good question. So the good news for us and Bryce and smaller funds is that there's been so much money raised above us hundreds of billions of dollars in private equity funds, bigger than us, over the last 10 years, that there's an unending list of larger funds that need assets that have been professionalized and cleaned up. So that when I started my career, it was, will Microsoft buy this? Will Oracle buy this? Right? We are building businesses to get in the way of their strategic. We were basically outsourced R&D for strategic software buyers for the first 15 years of my investing career. We still think that way. So I'll back it up. Can we price and structure the deal to get our money back? If we bought it well, outside of an auction, probably below market, but we could argue about, we play market clearing prices, obviously, because we buy companies. But did we think we got it for, a good deal? Can we structure it in a way where our capital is senior or in some sort of, participating preferred, where we're double dipping on the preferred and the common and getting a dividend? Could we structure, price, and recap our way to get our money back, even if the market isn't great, right? And I tell my investors, we take end market risk. Sure, I'm taking team risk and some tech risk. The tech works, but maybe it's not that fancy. But none of our companies are getting bought for the tech stack. They're getting bought because they have thousands of customers transacting at a good gross margin and a good profit margin with good gross prospects and blah blah blah. But can we price, structure, and recap our way to our money back? Can I run the business better, execute better to make a double? Could I do some M&A and some tuck-ins to get to a triple? And, beyond 3 times your money in 4 or 5 or 6 years, I think so much has to go right for that to happen that, maybe you got a little lucky. So, we're not trying to swing for the fences on every deal and have a ton of volatility. So if I can pack that in, I can deliver, I think, an outsized fund return. But hey, talk to all the value investors for the last 15 years. It's been rough out there. Right? Momentum has been the flavor of the decade. I'm not sure. Is there value investing in private equity? I'm not so sure. What's the intrinsic value of a private software company? Not sure you could convince me that there is, but we're value oriented. We care about entry price. We think you make a lot of your return on the buy, and then you can execute, add on, and market time your way to an outsized return. But if you just do the basics, could you make 2 to 3 times your money? That feels like a safe place to be. And the market can be hot. The market can be soft, right? We're not riding the wave of, valuations are up. Now's the time to sell because I can make a return. But if valuations are down, I'm in trouble. We're coming in at significantly below the 30-year average of a software business. And we look at the world in 20 to 30-year chunks, not in 2 or 3 year chunks.
Right. It's interesting what you said is you make your money on the buy. And earlier you were talking about getting a good company at a good valuation is a big difference. And I was talking to an investor a little while ago, and he said to me that, if you can get 2 to 3x on a fund, that is a phenomenal return. And a lot of people would take that. There are folks that try to swing for the fences and try to get 5 or 6x, but in general, that's quite rare, way more rare than people would think, especially when you start factoring in all the external factors that come into play, transaction costs, paying out cap gains and everything else that goes along with working in this market. And so even from what I'm hearing from you is just about having the realistic expectation is key to having a healthy investment approach.
I hear the same thing. I've got all the data. I subscribe to Preqin. I see all the public data from all the big public pension funds. Pretty easy to find a lot of data on fund returns for the last 30, maybe 40 years. Just sort it by how many people have returned. Private equity, not venture, return a 5x fund. GTCR put up an 11x fund on an $80 million fund in, I think, 1982. So, if there are people out there saying they're trying to put up a 5x private equity fund, I mean, that'd be like flipping a coin a million times and having it come up heads every single time. It's possible, but it's certainly not something you can manage towards. And if anybody who said that did that at a skill, I'd when I talk to them about the difference between skill and luck, you can have one thing just blow it away. That's amazing. Now, the sad thing is an LP will say, well, you can't replicate that, so I'm not going to give you credit for it. It's like, well, I just did it. So like, come on, give me a break. And if you don't do it, it's like, well, this other guy did it. Again, 2 times net, you do 2 times net over your career. Like that's Hall of Fame private equity returns. Now that has all been, it's gotten a little noisy the last few years because I think a lot of TVPI out there looks really juicy, especially in tech, but you can't eat TVPI. You can't eat IRR. You can eat DPI. So like, let's see how the DPI comes in because there are a lot of amazing funds in 99 and early 2000, and I think we're in a similar category, except the quantum of capital that's in tech private equity is 10, 20x what it was back then. So that's all got to go somewhere and it's going to figure itself out. But again, if you're starting a firm and you're like, hey, I'm going to do 4x net REIT funds, great, go for it. I would say raise $40 or $50 million funds. That's how you could get there, $400 or $500 million. There was once a stat, I think the Aberdeen guys did it or Makita or somebody was, not too long ago, there was no $2 billion fund that had ever returned more than 2 times net, like fully liquidated. Maybe at one point it was above that, but like it's very hard to generate 3x net on billions of dollars of funds. But maybe people are doing it. I just, I'm not seeing it.
Yeah, when you net out everything, I've heard from some of the larger funds that we work with that are 10 billion plus, that 1.5x is a home run when you. If you can get there, that's like a great return. And I get it at smaller fund sizes, you may want a higher return, but I think just that perspective is so important because the world gets smaller. You don't need to kind of do everything. And I liked even how you explained your value creation approach. It wasn't 30 things. It was just getting 2 or 3 things right. And if you do those things extremely well, you'll get to that return on a particular investment.
Hey, I think simple execution is highly underrated. Just execute the base business. So we're looking for businesses that are hard to hurt, right? This fax business had 2,000 customers. No customer was more than 1% of revenue. I had 40 years of financial data for the business through multiple cycles. I saw how it did in 08, 09. I saw how it did in 2000. We bought it in 2021. I saw how it did during COVID. I was able to see all that data. And the team was like, here's everything we haven't done, right? We just haven't gotten to these things because the owner is maximizing profits. And here's the things we would do if we could open up the purse strings a little bit. And those are the things we did. It wasn't rocket science. It never is rocket science. And private equity firms who take credit for the value creation, and I don't even like the term value creation, inside a business, it's like, well, it's the management team that did it really. Like, how much did the private equity firm really do at the end of the day? Maybe we set the right incentives, the right expectations, gave them some frameworks, were good sounding boards and things. We've got an in-house operating team. They're on a plane all the time. They're inside these companies all the time. Of course, they're making changes and adding value, but we would never take credit for it. That's always the management team who gets the credit for doing that stuff. And again, that's balancing that urgency and empathy. And now we're on, whatever generation 3, 4, or 5 of private equity. You're also on generation 3, 4, or 5 of management teams working with private equity. And if you talk to management teams who've been successful, they have very strong opinions about how they want to work with a private equity firm. And they get to choose, the best ones get to choose with who they work with, who they want to work with, and how they want to work. Our goal is that our approach is empathetic but urgent, experienced and approachable. Like we win a lot of deals in the room with the founder who's like, I don't know who ParkerGale is, and I don't know who any of these other firms calling me are. They have no idea what the AUM of these brand name firms are. They have no idea who they're talking to inside these firms. Do they own the place? Or are they just an employee? Are they on the investment committee? So it's very confusing to them, and they don't care because they're not reading Dan Premack every morning, and they're not reading the Bain private equity report the day it comes out about value creation, all the things. They own their business. They care who owns it next, but they're walking away. So they care up to a point, right? So we don't keep the founder on to tell our new CEO what to do and how to do things and second guess them. We need total clarity on we're going to do these things. We're going to make these changes. Are you comfortable with that? And most founders, certainly ones we deal with, are like, yeah, I'm very comfortable with that. I want you to do that. And I'll be excited to watch it happen. And I hope I can make a bunch of money on my rollover, but like I'm going to the beach. Mm-hmm. And that's the situation we look for.
Post-close, where do you usually focus? You mentioned three things: the professionalizing the team, getting the sales team ramped up, and then resolving tech debt. Would those be the top three areas that you're seeing most value left on the table that you can then capture post-close?
Yeah, I mean, we have a relatively small team. We run small funds. I've got 3 in-house on my payroll, full-time in the carry, operating people. So we don't have operating partners who are consultants. We don't have operating people who charge the portfolio. We don't, all of our operating team is in-house and sitting in the same meetings and deal sourcing and structuring and acquiring and diligence and everything. So we're kind of one team working on it. We've got an ex-CTO who takes care of the tech stack, tech debt, integration, tech diligence, and all that. That's Jim Milbury. We've got a go-to-market guy. That's Paul Stancic. He was a sales guy. He was at Bain for a while, and he's been working with us for almost 6 years now. So he's go-to-market. So that's just like, who are your customers, right? Get the customer cube in diligence. Like, how many customers do you have? What do they own? And if you have multiple products, how many customers own all the products you own? Oftentimes in a founder-owned business, they have 1,000 customers and 200, and they have 4 products, and the average customer has 1.2 products. It's like, okay, just sell more to the existing customer base. Basic stuff like that. Then how do you do prospecting? How to use AI in interesting ways internally? How to use all the tech stack in sales and marketing to get more insight, more data, more predictability? And then systems. The fax business we bought, which we've already sold, didn't have a CFO for 40 years. They were running on an unsupported old version of Great Plains. Like I said, they had 2,000 customers, right, doing thousands of transactions a week across multiple products. In diligence, Cass, on my team, who is a CPA, worked in transaction services for an accounting firm, was our first associate, went off to business school. So she's built all the AR waterfalls. She's built all the systems. She's built all the reporting for us and our companies. And now she runs that for us across the portfolio. So very quickly, we're getting data we can make decisions on. So if we can pay down the tech debt fast, right? And when I say tech, every company has tech debt, every company, right? We may step into some more monolithic systems than others, but we're more technical than most other private equity firms. So we're comfortable doing that. And Jim Milbury is 40 years in being a head of engineering and CTO, and we can do some really cool things that other funds would look at and say too hard, where other funds would hire a third-party tech diligence group to say, don't touch this with a 10-foot pole. And we would say, why? It's like, well, because it's built in Power Builder or something, right? We don't like the tools it's on. It's an unsupported version of an old technology. We would look at it and say like, oh, we're quite good at moving things from Power Builder to something else. We're good at transitioning a tech stack. And if you're really good at AI, that stuff can happen faster and faster and faster, burning down tech debt if you're really good at it. And I think Jim is really good at it. So we'll step into those things. We're also stepping into nascent sales and marketing. The phone is just ringing, but it's ringing less than it used to because they're not, refreshing the messaging. They're not listening to customers as much as they maybe used to. And systems are all over the place. If I get those 3 things in diligence, now most of our deals aren't in a process either. Like the fax business, we signed up to 100 days of due diligence, right? And it was because that's what we needed. We had to get the financial information. We needed to analyze it. We needed to do a Q of E on it. Then we needed to diligence it. It didn't exist. Where maybe other people would look at that and say, that's too hard. So everybody we buy from has options. they're getting called by every private equity fund on the planet, or not even getting called. They're getting emailed by every private equity fund on the planet. We all have Source Scrub. We can all email everybody in mass volume all day, every day, which I think is off-putting to most founders. And I like that most firms do that because we think we do it differently. And so how do you differentiate yourself in that? And then how do you get them to choose you? And then all the other stuff is just basic private equity stuff, which everybody should know
kind of deploys. Yeah. That's great. I mean, thanks for sharing all that. I actually have so many more questions, but we're kind of coming up on time here. So if there are founders listening that want to potentially learn more about you, what's the best way that they can get in touch and learn more about ParkerGale?
Sure. Well, I'm at Devin at ParkerGale.com, DEVIN. So you could go to send it to DEVON and it probably will still come to me. But Devin, DEVIN at ParkerGale.com. We spend almost all day, every day talking to founders and owners of businesses who are in various states of should we sell. Again, this fax business I keep bringing up, I had been talking to the son of the founder for 3 years on and off. His dad wasn't ready to sell. And when he was, he says, hey, we could sell it to the big public competitor for this price, I think, or we could sell it to you for, something in that range. Will you take a look? So when he was ready, we were ready. We went out to Boston and spent, a few months getting to know the business better, but we had known the family for a long time. And he liked our approach because it was very product driven. And there was 21 founders he could call on their cell phone and ask what it was like to work with ParkerGale. Another way is a podcast. So we beat you to the punch. We started a podcast almost 11 years ago, and there's 350 episodes on iTunes and Google Play and our website, ParkerGale.com. So if you want to hear about how we do private equity, we like to say we do private equity with you, not to you. That's probably our unofficial tagline at ParkerGale. So you can hear exactly how we do things with the people we do it with, the people we've backed, the people we work with, the people that work for us. So really, it's kind of a very folksy, simple, down home, like let's just talk about the stuff, right? So we talk about what's an ICP, what's debt. In a couple of weeks, I've got the head of tech lending from PNC coming on, and nice. He's going to walk through basically like, here's where the lending market is right now for software businesses. Then we talk about, hey, how do we use AI in the portfolio? What's value creation? So, we walk through an LOI for founders with me and a guy from K&E. We walked through one of our actual LOIs term by term and explained it to founders so they could understand, okay, why do I need this? Why do I need this? What's the negotiation going to be around exclusivity? What's the negotiation going to be around, due diligence and fees and expenses and terms and all this? And me and the head of the Chicago office from Kirkland and Ellis go through that line by line and decipher it for founders and sellers.
Yeah, we'll include that as well. And with that said, thanks a lot for doing this, Devin. I think especially your insight on keeping this super tight and having the right types of expectations for companies and having a more deliberate approach to value creation. I really appreciated that. And I think a ton of people listening, founders and investors alike, can take a lot away from it. So I appreciate you doing this.
Hey, thanks for having me on. And, we didn't get to anything we talked about in the pre-interview, which means, Shiv, it was a good conversation because you didn't have to look at our notes once.
Exactly.
So I appreciate that.
We'll maybe do a part 2 sometime. So thanks for coming on.
Happy to do it.
Thanks for listening to today's episode. Before you take off, just a few requests from our side. Number one, if you enjoyed today's content and want more of it, please subscribe to the podcast on your favorite podcatcher. Number two, if you are in the market for marketing strategy consulting services, due diligence services, or fractional CMO services, please visit our website at www.howtosas.com and schedule a consult today. And number three, if you haven't already, grab a copy of my book, Post-Acquisition Marketing. It's available on Apple Books, on Amazon, and any bookstore that you can find online. Get a copy because it walks through the framework that we take all of our clients through, and it'll definitely add value to your business. And that's it for today. We'll see you guys next time.